Welcome to the WangHiro podcast, where we answer Malaysians' burning questions about personal finance with fact-based answers.
It's a new investing year for everyone, so we decided to do a special episode for Stop Investing from Zero. So instead of looking at a company, we'll guide you through how to deal with all the market news that you're hearing right now, and also give you some tips on how to handle your investing journey, whether you have already invested in the market or are planning to invest in the market. So John, what is the market like right now?
I would say it's a mix, and I'll tell you why. The S&P 500 for the year 2023 ended on a high, and it started dropping, and then second of January, 3rd of January, and then now it's like there's a drawdown, quite a bit of a drawdown. And even our community members who we advocate ETF investing, and they have like posted in the group chats. I said, oh, drawdown, and my response would be, great, I'm trying to load up, because you don't want to be chasing the stock or an ETF when the prices are keep climbing. You just want to have a discipline to like buy when it's low and sell when it's high, or just a discipline to like, regardless of the market, just go in. And we teach even very specific tactics that optimizes and efficiently uses your capital. But to your question about how is the market right now, it's mixed. Why? S&P US markets seem to be having a drawdown, while the KLCI just had a rally for the past 3 days, you see. And again, sometimes when we look at this news, then you start getting confused, like what you said, where it's like, what's going on? Malaysian markets rallying, and then US drawing down. So I guess that's where the allure to like follow the trend will always be there. But more importantly, when you invest in something, you need to find permeability. Not permeability, permanence. You need to find permanence in what you invest in. And I'll start out with this, which I feel it's a wonderful story that Morgan Howser just wrote in his most recent book as well. It was somewhere in 2009, the peak of the Great Recession. That means it's the trough of the market, right? And Warren Buffett was actually driving around Omaha with another company CEO, very famous one, he didn't name. And this CEO actually asked Warren, what's your view on the situation now? The US market is about to die, Baston's going bankrupt, all the stocks have like dropped more than like 50%, And it was driving around closed shops, Warren was like asked, would the country ever recover from this famous CEO, would the world ever be the same again? Because it's so doom and gloom, Louis.
It's just staring you right in the face, right? And you kind of have to confront it somehow.
Yeah. So Warren responded by asking this question, Louis. He said, do you know what was the best-selling candy bar in 1962? The CEO was like looking at him and like stunned. What kind of question is this? And he said, Snickers. So then this CEO was like just silence, Then Warren asked again, do you know what is the best-selling candy bar in the world today? So when he said today means referencing to 2009 lah. And then the CEO just dumbfounded looked at him and said, Snickers.
Wow, that's interesting.
So that actually ended the conversation. So obviously the CEO start talking about something else, about life, whatever. So actually the moral of the story from this is multiple fold. One, life goes on. Yes, market may be doom and gloom, whatever, but life goes on. People still eat, people still drink. Okay. The 2008 recession wasn't as bad as the 1929 or 1930s Great Depression, where people had to starve, there was food rationing, all these kind of things, you see. Even COVID, yes, we saw quite a bad, lines for people getting their household goods or whatever, but not many people actually died of hunger. You get me or not? Not like the Great Depression.
Right, yeah, like famine, right?
Yes.
Widespread famine,
right? Yes, we had the white flag in KL, but people actually stepped out and helped, right? So the point, first lesson learned from this, people need to eat, people still need to drink, and that is what I call, there's permanency in that. There is certain brands that transcend market rally, market bear. These are habits and behaviors of the human that will not change drastically over time. Let me ask you a question, Louis. You think about ChatGPT launched, all this new AI coming. Has it changed the world, changed the way people chew gum or not?
No, definitely not.
No. Has it changed the way your the male family members actually shave in your family?
No.
No, right? I think the only invention I've ever seen invented outside is the bladeless shaver lah. But even then, you still need to shave, right? And I still prefer using the shave lah. The normal shave is cleaner, right? So, as an investor, your role is to somewhat find businesses like this, because your question, and this is where I think it boils back to whether you're invested already or not. So, if you're invested, are the stocks or businesses in your portfolio having this kind of permanence or not? Whether market is up, whether market is down, will it change because of some new fad or some new trend? If it does, then I really want you to look back and ask yourself, why did you buy the stock in the first place? But if you have got this like permanent, stocks that are more permanent in nature, companies like your Procter and Gamble, companies like your FNNs, for example, companies like your Carlsberg, people won't change the way you drink beer and things like that, right? I'm just giving examples. In by no ways and means this commensurates a recommendation to buy, okay? But I'm just giving you examples how this has lasted. There was one, I don't know if whether you cook using Himalayan salt, Louis.
Sometimes,
right? And there's this company that I keep on joking, every time we go to a Japanese restaurant, we just take it for granted. We just pour it into our sauce plate, but you don't even realize the brand, and it's been a listed company for a very long time, right? I don't know if you noticed that brand or not, Louis. Every time you go, it starts with a K. It starts with a K.
I do know the brand, but no, it's not memorable. I buy it sometimes,
You buy it sometimes even, right?
But
it's such a good size stuff, right?
I forgot. See, it's not memorable.
It's called Kikomen.
Kikomen, yeah.
Yeah. So again, these are things of permanence, and I think once you understand human nature, human psychology, human behavior that doesn't change over time, then you are somewhat better insulated against whether the market is rallying, whether the market is like in the doldrums, you see. Because what the market will do is herd mentality. But at the same time, you have to realize that businesses behind these stocks have people with herd mentality as well, which is they will eat the same thing, they will frequent the same places they go, they will have the same brand that they will consume every day. And even if there is a technological change, you really ask Apple users, do you think 100% of them know what is an M1 or M2 architecture, 16 gigabyte of RAM? They won't. They just know it's Apple, right? It just works. I turn it on, I know where my home button is.
As long as the things that don't need to change stays the same, I think they're quite happy, like I am, and I guess you are.
Yeah, precisely. You if you want to edit a video, yes, you may only. I'm a tech geek, so I know what goes in behind the scenes. But like, I would tell you, a lot of video editors out there also, they don't really know, but they just know that M1 is fast, kind of thing. You see,
so very efficient as well.
Correct.
Yeah, I mean to that, right? Like so does it mean that when we hear like either positive or negative news, we shouldn't really respond, or we should still review our portfolio in a way?
I would say do not react. There's a difference in between response and react.
Right.
React means it's knee jerk. It means you see and then it's straight away, right?
Sell.
Yeah, but I would say the way you respond would be like, hey, it doesn't seem like the company I bought has some permanence, right? It doesn't seem like, they, with the current high interest rates, these companies can actually survive. Now, actually, a lot of people say that COVID is a bad thing. I always look at the silver lining in behind all these bad things. The bad thing is, yes, a lot of businesses close, but a lot of these businesses that stayed open and survive, that when another COVID equivalent kind of scenario comes, these guys are going to survive the next round. Why? They've built certain systems. They did not take risks. I keep on telling people this, especially in business circles. If you've been to KL, you know this restaurant called Esquire Kitchen, right, Louis? Esquire Kitchen, the green color. It's like a franchise. Okay.
Don't remember.
Stir fry Chinese. Okay, it's like what would be an equivalent in Sarawak? Okay.
I don't think we have an
Yeah,
equivalent.
you don't. Yeah. Okay. So this was a franchise Chinese restaurant. They serve like 20, 30 ringgit dishes. Okay, and that was in the middle end. On the top end, there's this chain of Chinese restaurants called Grand Imperial. Very, very luxurious. It's like the overseas standard or even higher. Okay. And before COVID, their owners actually leveraged to the hilt. They wanted to expand, leverage to the hilt. What happened during COVID was that they had a cash crunch and they had to sell the entire business. And Esquire Kitchen, being cash rich, actually acquired the whole chain. So it's quite insane. So for me, yeah, it was reported quite publicly in the Age, one or two articles. But for me, I mean, like, I'm always interested in entrepreneurship, businesses, and that kind of thing. For me, it was a very good lesson in remnants to what I just shared about Snickers, about Warren. Businesses still, people still need to eat. Once the COVID comes back, whatever, people will flock back to the restaurants. But the lesson learned for Imperial was that when money was close to zero to borrow, low interest rates, do you have the discipline to realize that this is not going to stay the same forever? Did you think about the scenarios where when interest rates actually double, which they have, and can you actually service the loan? Will you be able to make it, doing? And Tan Sri Jeffrey Chia of Sunway, I've not shared this story publicly before also. I think he did share this publicly, so it's public information. It was actually at a seminar, Malaysian Australia Business Council. I had the privilege of meeting him. He nearly was wiped out during the 97 crisis because he over-leveraged as well. Same thing. So after that, right, when he took loans to expand for the future, he was very cautious already because once bitten, twice shy.
Yeah.
So if anything, if you don't remember what I just said throughout this whole session, Louis or the audience out there, remember interest rates, the growth prior to 2008 was fueled by very low interest rates. Post 2008, even worse, because the US governments around the world were just going on a monetary easing policy, which means print money, lower interest rates so that people are willing to expand business, expansionary measure, okay? But times like that don't last. You cannot run an economy where there is negative inflation like in Japan, negative inflationary rates, negative interest rates policies. You cannot. Nobody will want to take that kind of, nobody would want to take that kind of risk to actually. No, they must be a barriers to risk. Sorry for saying that the other way. They must be a barriers to entry for risk. That means you cannot borrow money at negative and then expand your business. It must be some kind of a hurdle of a risk for you to borrow money, take that kind of risk, and then expand the business. Businesses that survive already put this into their projection or strategic planning. Those that recklessly expand because interest rates were cheap and then just expand till kingdom come, they paid the price during COVID. They paid the price nicely. And why is it all related? I know for those listening out there and you're like figuring out, what is John trying to do? Interest rates correlate too much to returns on any investment asset, especially equities. High interest rates, equity markets will go into the dump. Low interest rates, equity markets will go sky high. So there must always be a balance. Am I making sense, Louis? Because you think about it, fixed D at 10%. Why put into the stock market? I just put money in the bank.
I think it's like when we imagine the ideal scenario, we don't think about the repercussions.
Correct.
You think, this will be good, but is it really good? Like in the long term?
Yeah.
It's good now, but nothing will sustain it, I feel.
Exactly. And now a lot of people are pulling money out of equities and then going into fixed income, which is bonds or whatever, because interest rates are high. But the moment the Fed starts cutting interest rates this year. Okay, it's predicted they're gonna like either stay stagnant. Okay, because the past quarter was already stagnant. So if inflation comes down and the Fed starts cutting interest rates, okay, what will happen to the stock market? It will actually start jumping already, you know. Which is the opposite end. You see, again, as investors, you need to be leading rather than lagging. You don't want to be jumping into the market when everyone has already jumped, the market is exuberant. You need to position yourself as a contrarian. I know, John, why are you talking about this in a basic podcast? I said, yeah, the struggle is this. If you follow herd mentality, that's why you get herd mentality results. You have to be, it's kind of arrogant in a way because you have to think against the crowd, but actually that's where you make money.
Then I have to first be aware of what the crowd is thinking. I feel
yes,
the hard part.
yes,
Whether are you amidst the crowd or not, you have to kind of make that distinction. So that comes with some self-awareness and the awareness of the environment, I feel.
Yes.
Okay. So I think we covered quite a bit about like how the market is moving, and if you had some investments already, especially in equities, this is how you should respond. But what about, John, those out there in our audience who haven't invested yet, and now they're entering the 2024, maybe they have some resolutions around maybe improving my portfolio, actually starting a portfolio, looking at these market conditions. Does it matter? What should they do to get started?
Great question. I think because you are taking those baby steps, you don't want to start jumping and hopping around in the markets. What I mean, you want to take those baby steps so that it will encourage you to stay invested. So many ways, but I think the most cost-efficient way for me is actually buying what we call the broad market. So now the broad market is down, especially in international markets. It's actually the best time to buy because what you escape yourself from doing is the individual stock picks. Because let's just say you pick one stock and it went wrong, right? You don't achieve that kind of diversification. You may not have the skills necessary to know that whether this stock will actually be a good one, and the markets may be against you. You may have picked the right stocks, but your patience was only 1 year and the stock moved after the third year, you see. So again, there's a lot of nuances and risks involved if you do individual stock pick. Might as well, if you are a beginner, you're just starting out, buy what I call a broad market basket of stocks. So the basket in itself is the diversification, and you are not compelled to actually make one or two winners or losers, from individual stock picking. I think that's the easiest way to start. Once you get the hang of it, you have your brokerage account, you already have a few shares, and then you get the hang of like the market. Then you say, out of these baskets of stocks that I own, what are the things that I want to improve further in my know-how, in my knowledge? Maybe it's your circle of competence that you're a software guy. Then you start digging deeper into technology. Okay, you can choose to buy an ETF that is like in a technology-based sector because that's your circle of competence. Or you said, oh no, I always buy hardware from this particular company, and every year we give them business, and I like this business model. So before you even get there, a lot of people give excuses and procrastinate at the head. Oh, I want to get there before I buy. But no, you will only get there when you start. You see, you only get there when money is on the line, and you say you think about it every day. It's like, put it this way, if you are not paying for something, right, it will be like you will just brush it off because it's free, There's no risk involved. There's no equity involved. You don't put your time equity. You don't put your money equity. You wouldn't think about it. But once you start, then how is the market doing? Hey, how come this stock did better than this stock? Hey, how come this index, this particular industry did better than this? You see? So it gets you thinking, you see, once you put money in. I hope I'm making sense to you, Louis.
Yeah. I think it's like if you've made the conviction to get started, it's high time to just get started, right, John? As long as you're financially prepared to do it.
Yeah, exactly.
Okay. So I think we've covered all the tips and the market outlook. Now let's go to the last bit, which is the book recommendation. So every time we have a book, but today probably we don't have like really an investing related per se, but something to get beginners started. So what's the book for today, to prepare for the year ahead?
Yeah, I think again, there's a lot of flack to this particular author of this book. A lot
Yeah.
of people say that he made money from books and now he's a bankrupt and all that kind of thing.
Yeah, sure.
But I think I have to give him credit where credit is due, where he opened my mindset to owning something, owning either property, or he didn't say much about equity, but owning something. And actually, for me, the most compelling was the quadrant, the cash flow quadrant.
Yeah.
Whether you're an employee, whether you are a sole proprietor, whether you're a business system owner, or whether you're an investor, that quadrant for me really got me thinking. And why I thought of this book as a recommendation is for those who have not read the book but want to jump straight away, want to jump into equities, thinking that you earn 3,000-4,000 and then I get into equity, I turn 3,000 ringgit into 300,000 overnight. That's not gonna happen. Okay, it's not gonna happen, right? I want that mindset shift to happen first. And as I was like thinking about this book, there is another book that I think is very good for mindset change. It's called Think and Grow Rich by Napoleon Hill. I've not personally read.
You didn't introduce the first book, John.
Oh, I didn't introduce. Okay.
You didn't mention the name. Then you went directly into the second book.
Yeah. So the first book is actually by Robert T. Kiyosaki, and the book is actually Rich Dad, Poor Dad. I read this book. I was very lucky. Someone paid it forward to me, introduced me this book at 19 years old. And when that actually happened, my curiosity, my brain cells just started firing, and that set me on the path to where I was today. Okay, so really great book. Watch out for the cash flow quadrant. Really embody that kind of mindset shift. And yeah, the second book is actually Think and Grow Rich by Napoleon Hill. I think it is also a mindset shift book, because once you go through these two books, it will just shape or shift the way you think. And that needs to happen first. You don't need to like listen to people, oh, Louis is into properties, or John is into stocks, or my friend C is into crypto. And you like, I like the way Casey puts it, Casey Lau, our common friend, right, Louis? It's like on a scale of 1 to 10, right? People want to go to the scale of 9 and 10 straight away. But they haven't gone through scale 1, 2, 3, 4, 5, 6, right?
Yeah. Baby steps.
That baby steps. It's like you want to build KLCC, but you haven't piled the foundation. That for me is very dangerous, because they want to solve that problem quick. They want the money quick, right? But unless until you get this foundational mindset shift done correctly, you will struggle here. I've seen so many. I've seen too many already, actually. Yeah.
You go back to the same roadblocks, I feel.
Correct.
Because
Correct.
There's something you haven't gone through and you're like, oh, I want to do this, but yet it's the same limiting beliefs that will limit.
Yeah.
And very coincidentally, those were also two of the first like finance books I also read. And I can attest that they really helped me to have a lot of mindset shifts around money. Yeah.
Precisely. Because I like the way you said like that roadblocks, right? People who don't do the 1, 2, 3, 4, 5, and they come to 9 and 10, thinking they can be 9 and 10. You know what they end up to be? They end up to be speculators.
Right.
They end up to be speculators. They don't understand the foundational. They want to go that they want to get 0 to 100 in like 1 second kind of thing, and they end up chasing fast money. They may get lucky once or twice, and then they get burned very nicely after that.
A lot of gurus will sell you that, right? If there's gonna be some course on options trading, which is actually a very complex financial product, in my opinion.
Correct.
But telling people that beginners can actually do it without problem, it's easy, that kind of thing lah. So I think this is quite important lah.
Yeah, exactly. So Louis, I hope the audience out there, as I summarize this, think about something of permanence, and think about what is your foundational understanding of wealth. If you don't understand these two things, I think it's very hard for you to have that breakthrough for the lack of a better word.
Agree.
Yeah.
All right, so that wraps up our very first episode of Stock Investing from Zero. So over to you, our audience. I want to know, how is your portfolio looking right now? Or those who haven't invested, what's your plan for 2024? And if you've enjoyed today's video, make sure to give us a like, subscribe, and hit the notifications button for more videos around investing for Malaysians. Thanks for tuning in today, and we hope to see you again in our next episode. Bye-bye.